Okay, so a $20 billion fund just got margin called, and nobody's talking about what actually breaks because of it. Let me walk you through this. The All In podcast dropped something 3 days ago that landed with 421,000 views. The signal was clean. Institutional investors who bet big on AI infrastructure build-out are getting liquidated. Not because the AI thesis broke, because they borrowed too much money to position for it. Here's the cascade. You've got hedge funds that levered up hard on semiconductor stocks. NVDA's been the play. Chip stocks in general. The narrative was simple. AI compute demand is infinite. Semiconductors print money forever, build bigger data centers. Everything goes up. So they borrowed against their positions. 2, 3, sometimes 4-to-1 leverage. That works great until it doesn't. What happened this week is the kind of thing that's supposed to be predictable, but somehow always catches people off guard. Chip stocks started selling off, not collapsing, just correcting. NVDA's down from its highs. The broader chip sector's feeling the pressure. And the moment that sell-off hit, the margin calls started flowing. Funds that were sitting pretty on paper losses suddenly had to actually post cash. Real money. And a lot of them didn't have it liquid. So here's where it gets interesting for anyone holding Elon positions. When these funds start liquidating to cover margin calls, they don't sell just the thing that broke. They sell everything. They sell their winners to raise cash fast. And XAI and Tesla have both got real exposure here. Tesla's semiconductor supply chain is directly tied to the chip industry's health. Tesla doesn't make its own chips at scale. It buys them. And when semiconductor manufacturers start cutting production because demand signals got weird, Tesla's supply contracts get pressure. We've seen this movie before. 2022, 2023. Shortage turns to oversupply, pricing gets weird, and suddenly your component costs are different than you modeled. XAI is even more exposed. XAI's entire thesis is compute, custom silicon, data center build-out, massive GPU procurement pipelines. If institutions are getting margin called and pulling back on AI infrastructure spending, XAI's hardware roadmap doesn't magically stay on track. A $6 billion fund that was supposed to be a long-term customer just told you they're pausing. That's real risk. Invest Answers put out 2 videos in the last week that are worth watching. One titled Money Exploding, Indicators Flashing, hit 42,000 views. The other on AI compute plays also hit 42,000. The retail narrative is locking in. People are starting to price in the correction narrative. And honestly, after 2 years of AI is paused, people are actually listening this time because the sell signal is visual. The chart broke. Here's what everyone's missing though. The margin call cascade isn't the end of AI infrastructure. It's the liquidation of bad timing. Funds that levered up too early, borrowed too much, and got caught on the wrong side of a volatility spike. The actual AI build-out continues. It just happens at a different pace, with different capital sources, and crucially, with the weak hands gone. What matters for Elon's company specifically is speed of adjustment. Tesla needs to navigate semiconductor cost volatility without eating the margin. XAI needs to show that its hardware strategy doesn't depend on infinite institutional funding. If either one proves it can adapt, they come out of this stronger. If they get stuck defending old assumptions, they get hurt. The spin you're hearing everywhere is AI is paused or AI correction is healthy. True, but the real story is margin calls liquidating the overleveraged thesis. And that's a very specific kind of risk that hits certain players harder than others. Drop a comment. Are you watching your chip stock exposure right now, or are you betting on the rebound? And if you want the full picture on how Elon's companies are navigating AI infrastructure risk, I went deep on that in XAI's $6 billion bet, Why Tesla Bulls Are Missing the Real Play, link in the description. If you want more breakdowns on the structural risks nobody's pricing in, subscribe, and I'll see you tomorrow with more. And speaking of bad timing in finance, a horse got stuck on a cliff in Nevada County last week, and the only way out was a helicopter rescue. Not metaphorical, actual helicopter with an animal rescue team. The irony is perfect. You make a bad bet, you get margin called. You get trapped on a cliff, you call a helicopter. Both are expensive solutions to problems that had better exits if you saw them coming. The horse survived though. The funds liquidating this week probably wish they had it that easy. Thanks for watching. If you want more of this every morning, subscribe and I'll see you tomorrow.